Good morning everyone. My name is Helen Betts and I'm a category lead within the fleet team at Crown Commercial Service. Today I will be taking you through the cost of buying an electric vehicle, how to build your business case, the incentives, grants and budget funding available, before taking any questions at the end. So to begin, let's look at buying an electric vehicle. In the current market, commercial electric vehicles are widely considered to be too expensive to purchase in comparison with their petrol and diesel counterparts. Looking at a couple of examples from the table, the Mini electric car is approximately £3,000 more to purchase than the Mini Countryman. Equally, the new basic Volkswagen Golf costs approximately under £20,000, while the same electric vehicle would have a starting price just under £30,000. Equally, it is the same for the Skoda combustion and electric variants. Moving on to some price comparisons within the van market, which could also be of particular interest when thinking about changes to your fleet. As you can see, the starting price for a smaller van, a Kangoo ZE, is coming in at £24,000, with its comparator Renault Kangoo starting at just over £15,000. And at the other end, the VW ABT e-Transporter is coming in at £42,000 in comparison with the VW Transporter Diesel, which starts at £22,000. These figures suggest that there is a huge gap when contemplating moving to an electric vehicle, but there are other things to consider when looking at the price of EVs. Firstly, the additional cost of purchase is offset with the government currently offering a plug-in car grant and the plug-in van grant. This incentive was due to end in March 2020, but after mounting pressure from the manufacturers, this has been extended for the time being and sees drivers benefiting from up to £2,500 for electric cars, depending on the level of CO2 emissions, and up to £6,000 for any electric or plug-in van. In addition to the government incentive, and to counter the high initial cost of an electric vehicle, many manufacturers like to look at the total cost of ownership or whole life cost. Because while the initial outlay is high, you can save hundreds on everyday running costs, chiefly in terms of fuel costs, with electric vehicles costing around a third of what petrol and diesel cars do if you're charging at home, and also the service and maintenance costs are vastly reduced as an electric vehicle has a lot less parts to a combustion engine vehicle. So for this we think engine, radiator, pistons, spark plugs, fuel pumps, to name but a few. And therefore by switching to an electric vehicle, maintenance costs can be reduced by approximately 50%. There is also less wear on the brake pads due to the regenerative and efficient braking systems, which use the electric motor to slow the vehicle and put some electricity back into the battery. The only offset between the two types of cars is the cost of tyres, where you wouldn't necessarily see a reduction in the wear of tyres with an electric vehicle. The extra cost of manufacturing battery electric vehicles versus their fossil fuel equivalents will diminish to approximately £1,500 per car by 2022 and will disappear completely by 2024, according to research by the investment bank UBS and Deloitte. The research is based on detailed analysis of batteries from the largest manufacturers who are able to increase their choice of models as battery prices per kilowatt decrease, with some optimistic commentators expecting manufacturing price parity by as early as 2024. Next, we will look at how you can build your business case to senior leadership teams. We will look at what figures you need to know to prove value, what are the tax benefits, and what are the typical running costs of running an electric fleet versus standard fleet. The electric vehicle market is growing rapidly, manufacturing costs are falling, and the government is committed to an increasing electric vehicle adoption. Increasingly, public sector organisations are using electric vehicles in their fleet to maintain or elevate the quality of fleet operations, reduce fleet expenses, and fulfil their environmental commitments. However, barriers to implementation do exist, especially in the public sector, where stakeholders can struggle to build a robust business case which could advance adoption by effectively communicating to decision makers the environmental, economic and social advantages of electric vehicles over conventional vehicles. There are a number of key considerations that should be examined when forming an electric vehicle business case. Ownership costs, vehicle administration costs, fuel costs, maintenance costs, total cost of ownership, charging infrastructure costs, and overcoming barriers to change. These considerations can help identify opportunities which best match fleet needs and optimise benefits. The following outlines each consideration to assist fleet managers and other stakeholders to build a robust electric vehicle fleet business case. Ownership costs. An electric vehicle business case begins with the scoping of new vehicles that can successfully meet the fleet needs, from range, rapid charging capability, and low capacity. Once possible vehicles are being scoped, it is important to consider their purchase costs. With some electric vehicles attracting the additional plug-in grant discount, this means the actual cost of ownership could be significantly reduced. Factoring in these discounts can create substantial savings relative to conventional vehicles and can be critical to ensuring the success of the electric vehicle business case. Vehicle administration costs. It is important to consider whether any extra electric vehicle insurance premium, penalties or benefits apply, and to select a cost minimising insurer accordingly. Researching different providers and acquiring a range of quotes is definitely recommended. Fuel costs. The main benefit of electric vehicles is their reduced fuel costs, with estimated savings about 60 to 70% in comparison to conventional vehicles. Some business cases have examined fuel costs for specific electric vehicles and provided ranges of savings compared to similar conventionally fueled vehicles. Nevertheless, potential energy costs and savings are often sensitive to the specific operations of a fleet. Therefore, to accurately capture total energy costs in business cases, two elements should be considered: local fuel prices and actual fuel economy. Combining the information on local fuel prices and actual fuel economy can produce an accurate total fuel cost for all vehicles. There are different approaches to do this. Some customers consider fuel costs over a preset distance of travel and calculate a total fuel cost per unit of distance, while other customers have compared the total lifetime fuel cost by extrapolating energy costs over a vehicle's projected annual mileage and expected service life. Both approaches are perfectly fine and can be used to compare fuel savings between fossil fuel and electric vehicles. Maintenance costs. Battery electric vehicles and plug-in hybrids contain fewer moving parts and have less fluids to change compared to conventional vehicles, which can translate into significant maintenance cost savings. It is important that business cases capture this accurately, containing maintenance costs which cover costs associated with regular and preventative maintenance. As with energy costs, effective business cases extrapolate maintenance costs over vehicle service life to derive a total lifetime maintenance costs. Again, using this common metric allows for a direct comparison between fossil fuel and electric vehicle maintenance cost savings. Total cost of ownership. This approach involves extrapolating ownership costs, vehicle administration costs, fuel costs and maintenance costs across a vehicle's service life, and so provides lifetime costs under each category. The sum of these minus any resale value provides a total cost of ownership. Deriving a total cost of ownership clearly identifies the costs and savings that accrue across the full service life of a fossil fuel versus electric vehicle. This is an effective approach because it highlights how electric vehicles are a cost-effective option in the long term for organisations. Other considerations for your business case are charging infrastructure costs. As part of your business case, you will need to take the following into account: purchase and installation costs, charging costs, and grants and incentives available. You will also need to consider overcoming barriers to change. Like any large change, making a switch to electric vehicles can be disruptive to the business as usual fleet operations in the short term. Therefore, it is important to consider strategies that can be employed to help overcome these barriers. Business cases can be robust but can contain a degree of uncertainty. However, this doesn't have to be a reason for decision makers to rule out electric vehicles. Therefore, clear risk identification is essential. Typical risk examples include the discontinuation of incentive programs and significant changes in electricity rates. Therefore, a risk and mitigation strategy identification process can help ensure that uncertainty does not become a vehicle for the indecision amongst the decision makers. Next, I will look at the tax benefits for employees. It isn't just the progression in technology and infrastructure that is driving more organisations to consider part or fully electric fleets. There are now significant taxable benefits. When it comes to offering your staff company cars, the common drawback is that often they create more personal tax liability than they save on the company's corporation tax bill, meaning many employees choose to opt out of having one altogether. This is because employees taking company cars are liable to pay benefit in kind tax to reflect the monetary value of the perk. Whilst this varies depending on the vehicle, it can be more cost effective for employees to use their own car and claim the mileage back instead. This has meant dwindling take-up and organisations missing out on the benefits of offering company cars, namely attracting employees, deductible repair and maintenance expenses, capital allowance relief, and reclaiming VAT of purchasing. but now pure electric cars pay only 1% company car tax, rising to 2% in 22-23, compared to the 37% at the opposite end of the emissions scale. There are similar benefits to the employer to having an electric vehicle fleet. Firstly, they will enjoy reduced road tax, as well as employers reduce national insurance benefits to employees. While the overall total running costs are considerably lower with an electric version, and the residual value is greater than its combustion counterpart. What incentives and grants might there be for employers to choose when looking at electric vehicles? It is fair to say that the government has a long-term strategy to improve air quality across the country by discouraging the use of older, more polluting vehicles, and a short-term plan to reduce the numbers of areas where pollution exceeds legal limits. This can be confined to a single road or part of a city, and means that if your vehicle exceeds the emission standards, then it can be charged or fined for entering the clean air zone. Local authorities are imposing clean air zones across the country, with a lot of cities working towards these. There are 4 types of zones. Classification A is buses, coaches, taxis and private hire vehicles. Classification B is all of A plus your HGVs. Classification C is A and B with vans and minibuses. And Classification D is all of the above plus cars and motorcycles. To avoid being charged in the clean air zone, a car, van or minibus must reach a minimum standard of Euro 6 diesel or Euro 4 petrol. However, all EVs are exempt. In addition to clean air zones, the government also provides a lot of incentives and grants to entice employees into considering an electric vehicle over a combustion engine vehicle. I will touch on the main grants and incentives, but I will be happy to share a full list of these outside of the webinar. As previously mentioned, there is the plug-in car and the plug-in van grant. This allows discount on the price of a brand new low emission vehicle through a grant the government gives to the vehicle dealerships and manufacturers. However, given that the cost for an electric car and van is currently more expensive, the plug-in car and van grant aside, the government recognises the need to balance out the upfront costs of purchasing a vehicle with the overall maintenance and support. So as part of budget funding, there is an electric vehicle home charging scheme as well as a workplace charging scheme. This provides funding of up to 75% or £350 excluding VAT towards the cost of installing electric vehicle charge points at domestic properties across the UK. It is also important to note that each household can apply for 2 chargers if they have 2 eligible vehicles, so you are not restricted to 1 car charging at any one time, and the grant allows for up to 40 sockets at the workplace, which will enable you to move flexibly between work and home. In addition to these grants, there is the on-street residential charge point scheme from the Office of Zero Emission Vehicles, an energy savings trust. This gives local authorities access to grant funding and can be used to part fund the procurement and installation of on-street electric vehicle charge point infrastructure. OZEF has allocated £20 million of funding for 2021 for on-street residential projects with a maximum funding of £7,500 per charge point. For any concern with business journeys, Her Majesty's Treasury announced in March 2020 that they would invest in electric vehicle charging infrastructure across the country, which means that drivers are never more than 30 miles from a rapid charging station for longer journeys, where you may feel that a fuel station would be more convenient. Rapid charging points are located at motorway services and take approximately 30 minutes to charge an electric vehicle back to full battery. In addition to these grants and budget funding, the government has introduced tax incentives in the form of road tax exemption, which states that all electric vehicles are exempt from vehicle tax, meaning it's free to tax them. And then there are employee incentives, such as benefit in kind. And also there is the salary sacrifice package. This is an agreement that reduces an employee's entitlement to cash pay, usually in the return of a non-cash benefit. An employee can set up a salary sacrifice arrangement with an employee by changing the terms of the employment contract. Staff then give up an element of their salary in exchange for an electric car under this arrangement. And as your gross salary is reduced, you will save on tax, national insurance and pension. As I've said before, there are more grants, incentives and budget funding available for a variety of different sectors, which I would happily discuss separately to this webinar. In summary, while the initial offset cost of an electric vehicle is currently greater than that of its diesel and petrol counterpart, there are many incentives to make the transition from the combustion engine to a hybrid electric vehicle an attractive proposition. And I hope I've touched on many of these today to give you some food for thought on the future of your fleet requirements. Any questions?